Welcome back to the Daily Crypto Roundup. It's been another chaotic 24 hours in the digital asset markets, and today we've got four big stories shaping sentiment. Bitcoin's wild October slide and the surprising rebound that's following it. The emotional wave of FOMO and greed that's suddenly pushing prices higher. Beijing pulling the brakes on stablecoin projects from some of its biggest tech companies. And the UK's tax office stepping up its hunt for unpaid crypto gains. If you're listening right now, take 2 seconds to hit follow and drop a 5-star rating. It helps the show reach more people who actually want signal instead of noise. So before we get into the headlines, let's look at where the major coins are trading today. Bitcoin is hovering around $114,300, up nearly 2% in the last 24 hours, after briefly dipping below $110,000 earlier in the week. Ethereum is holding near $4,075, up 1.5%. Binance Coin sits just above $1,180. Solana is back at $203. XRP around $2.46. Cardano 69 cents. Dogecoin 19 cents. Toncoin $6.38. Tron 30 cents and Avalanche $23.10. It's a modest rebound across the board. Enough to give traders hope that last week's panic selling has finally hit its floor. And the big question everyone's asking, why is crypto pumping again? The short answer is because it just endured a reset. When the market flushes out that much leverage in a short space of time, it leaves room for smart money to step back in. Last week's liquidation event, roughly $19 billion wiped from open interest, scared a lot of over-leveraged traders out of the game. What's left now are cleaner balance sheets, healthier funding rates, and room for the next move. MarketWatch reported this morning that Bitcoin climbing back above $114,000 is mainly a technical rebound. Large funds are quietly buying spot coins again after liquidation data showed forced sellers were finally done. Barron's added that traders are taking cues from macro assets like gold and AI stocks, which are also in rally mode. When fear fades even slightly, risk assets tend to bounce together, but it's not just mechanics. There's emotion in this rally. Analysts at Kotak Institutional Equities called it a FOMO wave disguised as rational optimism. Their note says investors are piling back into crypto because they don't want to miss what they think might be a new leg of the bull market. And even though Powell's latest comments from the Federal Reserve hinted at no immediate rate cuts, traders are reading between the lines. Slower tightening means more breathing room for speculative markets. So this pump is emotional and structural at the same time. Structural because the leverage got flushed, emotional because investors are telling themselves the worst is behind us. Zooming out, it's worth remembering how brutal this month has been. October 2025 was supposed to be another Uptober, a tradition in crypto circles because it's often been a green month historically. But instead, Bitcoin dropped from $122,000 to $104,000 in a matter of days, its steepest October drawdown in a decade. Ethereum followed, losing almost 10% in less than a week. The trigger, as we covered earlier in the week, came from the renewed US-China tariff tensions. President Trump's remarks about expanding trade duties on electronics hit global risk sentiment instantly, while Beijing's retaliatory language about countermeasures only deepened the fear. Macro traders pulled liquidity from everywhere: equities, metals, and yes, crypto. So today's rebound feels like a sigh of relief. It's not euphoric. It's more like the market saying, okay, we survived that. One trader quoted by MarketWatch summed it up perfectly. Everyone who needed to sell has sold. What's left are the hands that can hold through chaos. And when you look at the numbers, you can see that conviction returning slowly. Exchange inflows are down 14% week over week, meaning fewer people are sending coins to sell. Derivative funding rates have turned slightly positive again, a tiny but crucial sign that long traders are edging back in. So what does this mean for your portfolio right now? It means patience. The big lesson from October is that nothing goes straight up forever, not even Bitcoin. Pullbacks cleanse excess leverage, and those resets often lay the groundwork for the next real rally. If you're accumulating, this phase can be a gift, not because it guarantees profits, but because it gives you time. When the hype cools, entries get smarter. And just before we move on, a quick reminder. If you hold any meaningful amount of crypto, make sure it's in your control. Exchanges freeze, apps crash, and market chaos doesn't ask permission. A hardware wallet like Ledger keeps your keys offline and safe. You'll find our Ledger link in the episode description if you haven't set one up yet. Alright, from market psychology to geopolitics now, because one of the biggest stories this week is happening in China. Several of the country's largest tech conglomerates, including Ant Group and JD.com, have reportedly paused their stablecoin projects after regulators stepped in. The Financial Times says both the People's Bank of China and the Cyberspace Administration of China raised red flags over privately issued digital currencies, warning they could undermine the official digital yuan, the ECNY. Now, this might sound technical, but it's a major development for the regional crypto economy. Hong Kong has been positioning itself as Asia's digital asset hub, openly encouraging stablecoin innovation while mainland China keeps its bans in place. The idea was that big mainland-backed companies could use Hong Kong as a testing ground, a regulatory loophole basically. But Beijing appears to have said, not so fast. Sources told FT that central bank officials privately asked several firms to shelve their Hong Kong stablecoin launches indefinitely. One executive described it as a polite but clear stop sign. The reasoning isn't hard to guess. China's leadership wants full control of digital payments through its official CBDC. Allowing private stablecoins, even under Hong Kong regulation, could split that control. And for a government already nervous about capital flight, that's unacceptable. What's interesting, though, is how global markets are reading this. Some analysts believe Beijing's decision could actually benefit Western-issued stablecoins. If Chinese capital can't find a home in Asia-backed tokens, it may flow toward US dollar-pegged coins like Tether and USDC instead. That shift could strengthen dollar dominance inside crypto, just as Washington debates new stablecoin laws of its own. It's another reminder that crypto isn't a closed system. It's a mirror for geopolitics. When one superpower tightens its grip, another gains influence. Economist Linghao Zhou of Peking University told Reuters this week, the ECNY will always have political backing, but private digital currencies will always have the speed advantage. His point was that innovation doesn't stop just because regulation tightens. It simply relocates. So we're likely to see some of these paused Chinese projects quietly move resources to Singapore or Dubai, both of which are courting crypto businesses aggressively. In the short term, this news has softened sentiment in Asian trading hours. Liquidity in Hong Kong markets dipped 6% overnight. But globally, it's seen as neutral to slightly positive, because it clarifies who's actually competing. The big takeaway? China's crypto policy remains as unpredictable as ever. For investors, that means one thing: stay globally diversified. Don't build your entire portfolio narrative around any single jurisdiction, especially one that can change its mind overnight. And that brings us back to the macro picture. Because while Asia debates control, Europe and the UK are debating tax. That's the third major headline we're watching. The UK's tax authority has quietly escalated its campaign against undeclared crypto gains. Revenue and Customs, HMRC, reportedly issued more than 65,000 letters in the past fiscal year, warning individuals they may owe tax on digital asset profits. That's more than double the number sent in 2023. The Financial Times reports that HMRC has been using new data matching tools linked to UK-based exchanges to identify users who sold assets during the last bull market, but never reported capital gains. They've also started cross-referencing bank deposits from major exchanges like Coinbase UK and Revolut Invest. For most everyday investors, this is less about prosecution and more about persuasion. These letters aren't usually fines. They're prompts to file or correct previous returns before penalties kick in. But it's still unnerving. The message is clear. Crypto might feel anonymous, but the taxman can see the footprints. One London tax lawyer told FT, "The tone has changed. It's no longer experimental enforcement, it's mainstream." And there's a reason for that timing. With fiscal deficits widening and inflation stubbornly high, governments everywhere are looking for easy wins on revenue. Crypto taxes are low-hanging fruit. If you're in the UK, the threshold for capital gains tax is just £3,000 this year, far lower than before. That means even modest profits can trigger liability. So, what's the play here for investors? Keep impeccable records. HMRC's recent guidance encourages people to maintain transaction histories for at least 5 years, including wallet addresses and exchange IDs. If you've been using multiple exchanges, consider consolidating your data before filing season hits. And this part's crucial. If you're receiving staking or yield income, it may count as regular income, not capital gains. The distinction matters, especially as Ethereum and Solana staking rewards fluctuate with network activity. We'll expand on that in future episodes as more cases hit the courts. But for now, the main takeaway is transparency. The era of crypto being off the radar is gone. As we move through the final stretch of this week, one thing is becoming clearer. This rebound isn't a fluke. The crypto market has been through a storm. A $19 billion liquidation wipeout, macro panic from tariff tensions, and now renewed regulatory pressure. And yet it's bouncing. The real question isn't why it's rising, it's how long it can hold. Because if you look at market structure, what's happening today is the same classic post-capitulation setup we've seen a dozen times before. Leverage implodes, retail panics out, and then professional money quietly steps back in while everyone's still staring at the wreckage. This week, that transition is obvious. Spot inflows are ticking higher again. Not from wild speculation, but from accumulation. Coinbase Premium, the price difference between Coinbase and Binance, has flipped positive, suggesting U.S. institutions are once again buying spot Bitcoin rather than selling it. Meanwhile, the CME's open interest in Bitcoin futures has climbed 3% since Monday, showing that institutional appetite is returning even after the chaos. And it's not just Bitcoin leading the way. Ethereum's been quietly outperforming the broader market since the start of the week. Analysts at Matrixport called it a stealth rally hiding in plain sight. Their note highlights that smart money wallets have been accumulating Ethereum steadily since the liquidation event, while retail has been slower to re-enter. That's a pattern that usually precedes a more sustainable move higher. Part of that confidence comes from the sense that the ETFs are working. Since the Ethereum ETFs launched earlier this year, they've seen consistent inflows, not at Bitcoin scale, but enough to show that institutional investors are comfortable treating Ethereum as a core allocation rather than a speculative play. That subtle shift in perception matters more than people think. It's what turns a volatile token into an asset class. Bloomberg analyst James Seifert said this week that the ETF pipeline has stabilized sentiment far more than it has driven price. Meaning even when flows aren't huge, the very existence of regulated Ethereum products helps calm nerves. It's the opposite of hype, it's credibility. And credibility is what this space has been missing for years. Even with that though, there's still a strange disconnect between how professional traders see this rebound and how retail investors are behaving. On social media, you can already feel the optimism boiling over again. Crypto Twitter is full of charts predicting Bitcoin at $140,000 by Christmas. TikTok is back to I told you so clips from people who claim they bought the dip. That optimism is what analysts call reflexive FOMO, where price creates confidence instead of confidence creating price. It's powerful, but it's fragile. Because the moment the next red candle appears, sentiment can flip just as quickly in the opposite direction. So it's important to stay grounded. This rebound isn't the start of a new bull market, not yet anyway. It's a technical bounce within a broader range. The market's still digesting macro uncertainty, regulatory overhangs, and liquidity fragmentation between East and West. The best traders are treating this phase like a chess match, defensive first, then opportunistic. One of them, Avi Fellman from Golden Tree, summed it up well. The best time to buy crypto is when no one wants to, but the best time to size up is when volatility is high and your conviction is even higher. Volatility is indeed back. Bitcoin's 30-day realized volatility has jumped to 52%, nearly double what it was in September. For traders, that's both a risk and an opportunity. It means tighter stop losses but also bigger upside when timing aligns. Meanwhile, altcoins are starting to show selective strength. Solana, after getting hammered last week, has bounced nearly 8% since Monday. Part of that is technical, but part of it is narrative. developers and funds continue to treat Solana as one of the few real alternatives to Ethereum's scaling ecosystem. Cardano and Avalanche remain quiet, while Toncoin and Tron are holding steady thanks to consistent stablecoin transaction volumes. Speaking of stablecoins, let's circle back to the China story for a second, because it ties directly into this market stabilization. By blocking Hong Kong-based stablecoin launches, Beijing has effectively reaffirmed that the only stablecoin allowed under its jurisdiction is the digital yuan, the ECNY. That may sound restrictive, but globally, it has an unintended effect. It increases trust in existing Western stablecoins. USDT and USDC together now account for over 92% of all stablecoin settlement volume. And with fewer Asian alternatives, their grip tightens even more. Tether's CTO, Paulo Arduino, made a subtle comment about it on X yesterday. He said, "Every regulatory move in Asia reminds the market why transparent, asset-backed stablecoins are essential." It was clearly a shot at China's opaque system, but it also served as free marketing for Tether. And you can see the reaction in the data. On-chain trackers show that USDT issuance has increased by roughly $1.2 billion over the last 10 days. Small in the grand scheme, but enough to indicate renewed capital inflows into crypto liquidity rails. That matters because stablecoins are the lifeblood of trading. When issuance grows, so does liquidity. And liquidity is what allows rallies to sustain without collapsing under their own weight. So ironically, China's attempt to tighten control might be fueling short-term strength in the global market it's trying to contain. So between China tightening, the UK auditing, and the US still waiting on Congress to finalize its stablecoin framework, the regulatory theme of the week is control. Governments want it, traders resist it, and the market moves somewhere in between. Yet, despite all of that, prices are rising. Bitcoin's dominance has actually increased to around 54%, showing that capital is consolidating back into the majors. Ethereum's holding firm near that $4,000 mark, and for the first time since mid-September, the fear and greed index has ticked up from extreme fear to neutral. That may sound minor, but sentiment indicators often shift before prices do. The other angle worth mentioning is that macro conditions are giving crypto a bit of a tailwind. The dollar index, which measures the strength of the US dollar against other currencies, has softened slightly. That often helps Bitcoin since it's priced in dollars. Gold and tech stocks are also up, which hints at a broader risk-on environment creeping back in despite all the noise about tariffs and inflation. So while no one's calling for an all-time high next week, the market's definitely showing signs of stability. A foundation rather than a frenzy. As for analysts, the forecasts are still split. Bloomberg's Mike McGlone believes Bitcoin will stay range-bound between $105,000 and $120,000 until macro clarity improves, but Galaxy Digital's Mike Novogratz said on CNBC this morning that he expects a push to $130,000 by year-end if the ETF inflows keep holding and retail wakes back up. Ethereum's outlook is similar. Most see it grinding sideways, but with potential outperformance if the ETF inflows expand or staking yields rise again. Solana's the wild card. Some analysts predict it could rally 30% if momentum traders come back, while others warn that liquidity is still too shallow for sustained runs. The truth probably lies somewhere in between. And that brings us to the big takeaway of the week: conviction. Markets like this test it. When headlines are chaotic, conviction becomes your edge. So if you're dollar-cost averaging, stick to the plan. If you're trading, stay nimble. And if you're just watching from the sidelines, remember that patience often pays more than prediction. Crypto's story is still unfolding, and this week's rebound proves one thing above all else: resilience. Because even after the worst liquidations in history, even after regulators tighten their grip and tax offices knock on doors, people still believe in this space. They still build, still trade, still hold. That's what makes it different. So as we wrap up today's episode, remember, crypto isn't dying, it's evolving. Slowly, painfully, but undeniably forward. If you've enjoyed today's breakdown, take a second to follow the show, drop that 5-star rating, and share it with someone who wants context, not chaos. And before we go, don't forget to secure your holdings properly. Self-custody isn't just a slogan. It's your insurance policy against whatever happens next. The ledger link's in the description if you want to take that step. The market's alive again, and the next chapter starts right here. This has been your Daily Crypto Roundup. And as always, we'll see you at the top.